All right, let's get straight to it. Today, we're cutting through all the noise, all the headlines. We're going to build a professional, actionable framework for valuing Berkshire Hathaway. And we're going to do it based on the single most important signal in the market right now. Let's begin. Take a look at this number, $354 billion. Let that sink in. That's the mountain of cash Berkshire Hathaway is sitting on. An absolutely unprecedented war chest. And that leads us to the central puzzle, the big question we have to answer. With all that capital just sitting there, ready to go, why has the master of value investing himself, Warren Buffett, gone 16 months without buying his own stock? You know, his silence here is absolutely deafening, and it is the key to everything we're about to unpack. So to solve that puzzle, we're going to break this down into 5 simple parts. We'll start by decoding Buffett's signal. Then we'll see why it clashes with what Wall Street's saying. After that, we'll build out 3 distinct professional scenarios with very specific price targets. And finally, we'll pull it all together into one clear final investment framework. Okay, first things first. We have to understand the most important piece of data we have. And trust me, it's not buried in some earnings report. It's in Warren Buffett's actions, or in this case, his inaction. So here's the bottom line. When the man who knows Berkshire Hathaway better than anyone on the entire planet chooses to stack up cash instead of buying his own stock, that sends a powerful, powerful message about its value. He is telling us, without saying a single word, that for him, the price is just too high right now. Now here's where it gets really interesting. Let's look at how Buffett's quiet signal completely clashes with what most of the so-called experts on Wall Street are shouting from the rooftops. So on one side, you've got Wall Street analysts with these sky-high price targets, some pushing close to $900,000. But on the other side, you have the man himself, Warren Buffett, who's pretty much just sitting on his hands, saying, nope, not at this price. This huge gap between market hype and the founder's own caution, that is a massive red flag. So how in the world do we make sense of this? Simple. We ignore the noise and we build a structured, professional framework. We're going to look at Berkshire through the eyes of 3 very different types of investors. We're going to look at a conservative investor who wants to think just like Buffett. Then we'll look at a near-term technical trader who's just looking for a quick score. And finally, we'll look at what I'm calling the Buffett disciple. That's someone who's waiting patiently for that deep value price, the one where Buffett himself would likely start buying aggressively. Okay, let's start decoding the numbers. First up, Scenario A, the conservative value investor. This whole approach is about finding an entry point that lines up with where Buffett has historically been comfortable with the valuation. Now, this investor is definitely not buying today. They're patiently waiting for a pullback, somewhere in the $630,000 to $680,000 range. Why that specific zone? Because it targets a price-to-book ratio between 1.25 and 1.4, and that has historically been Buffett's sweet spot for buybacks. The strategy is complete with a stop loss just in case the thesis is wrong and a clear plan to take profits as the stock moves up. All right, let's switch gears completely. Now we've got our second profile, the technical trader. This is a totally different game. It's not about long-term value, it's all about short-term chart patterns, support, resistance, and momentum. So a technical trader might actually see an opportunity right around current prices, jumping in between $735,000 and $745,000, because it's sitting just above a major support level. Their stop loss is super tight, around $720K, to cut losses quickly if that support breaks. And the goal? A fast profit, getting out at resistance levels between $760,000 and $800,000. This is purely a tactical short-term play. And now for what I think is the most important scenario of all, the deep value play. This framework is our attempt to pinpoint the exact price level where Buffett himself would probably stop hoarding cash and start deploying it in a big, big way. This is the zone. Between $590,000 and $630,000, this is where we think a massive buyback program would likely kick in. Why? Because it brings that price-to-book ratio all the way down to a range of 1.0 to 1.3, a level of value that historically gets Warren Buffett really excited. Now, this isn't a prediction that the market will crash. It's just identifying an incredible opportunity level if it does. So you might be asking, how could we even get down to those prices? Well, it would probably take a major market stress event. Think a recession, a sudden rate shock, or a really bad earnings disappointment. We're talking about a 20 to 30% pullback from where we are now. And while that's never a guarantee, if you look at history, there's probably a 35 to 40% chance we could see levels like that sometime in the next couple of years. Okay, so we've walked through all three scenarios. Now it's time to bring it all home. This is our final section, the investment framework. Let's combine all this analysis into a single, actionable recommendation based on a strict, professional screening process. Let's run the numbers as they stand today. First, the Zacks rank, which tracks earnings estimates. It's a neutral hold. For us, that's a fail. Next, daily trading volume is way too low for any big institutions to be interested. That's another fail. And finally, what are the insiders doing? They're net sellers, not buyers. That's a third and really critical fail. The conclusion couldn't be clearer. The key indicators are all flashing red. So, the final verdict from this professional framework is completely unambiguous. At current prices, you do not buy, period. The risk just isn't worth the potential reward, and more importantly, Warren Buffett himself is telling you the very same thing with his actions. So what's the strategy? You wait, be patient. The single most actionable thing you can do right now is set a price alert for $680,000. That's the top end of our conservative investors' buy zone. If and only if the price gets down there, then it's time to start paying very close attention. But, and this is so important, price alone is not the trigger. This is a conditional entry strategy. You only even consider investing if the price falls below $680K and the Zacks rank improves to a buy and insiders start buying the stock again. You need all three of those conditions to be met. This is about discipline, not emotion. And that really brings us to our final question. And this one isn't about Berkshire, it's about you. Think about it. Warren Buffett has the discipline to sit on $354 billion and just wait for his price. The market is designed to test your discipline. The real question is, can you do the same?